It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. This show is all about taking action, spurring you on to take a great step in your financial life. Thanks for being with us. My name is Mike Bernard. I am one of the certified financial planners on the show. I'm also your host. With me in the KFG studios, certified financial planners Kevin Korhorn and Josh Gregory.
There are some insurance professionals who suggest that a 20-year term life insurance policy is all anyone needs to protect their family from a tragic loss of a breadwinner or a parent, that sort of thing. Is this sound advice or a dangerous approach? We'll give you our take from a financial planning perspective today on the Wise Money Show.
Well said, Josh. Well said. If you have any questions, reach out to us. We'd love to help. You can find us online, wisemoneyradio.com. You can call or text us, 574-222-2000. That's 574-222-2000. We'll hit your question on an upcoming program. Or you can find us on social media, Facebook, Twitter, YouTube. You can submit questions that way. Just search Wise Money Radio. You can also catch other content there. Every episode's on the YouTube channel. We've got blogs and whatnot that we're pushing out through Facebook and normal announcements and that sort of stuff. So connect with the show that way as well. Life insurance, it's just confusing. It is complicated. There's lots of types. There's lots of kinds. There's different amounts. And when you couple this with the variety of opinions out there from financial professionals, well, are those professionals just a life insurance salesperson? Are they just an investment advisor? Are they a fiduciary? Are they doing comprehensive financial planning? It's just complicated. And all too often, just like Josh said, I don't even want to say financial professionals, some individuals, maybe some advisors, maybe some financial spokespeople, suggest a one-size-fits-all approach with life insurance. And you might have heard, you might have taken action on this that, oh yeah, you need 20-year term life insurance. What's your guys' take on that? Before we dive into the financial planning approach, what's your take on that one-size-fits-all? You just need 20-year term.
I have a totally different take. You might think it's about a different subject, which it is, but it's interesting to me, and I've observed this over time, whenever someone has a medical issue, they go and they work with a doctor. And then whenever they're describing that to me, it seems, maybe this is just anecdotal evidence, maybe this doesn't happen to anyone else, but whenever they describe they're working with this doctor, they always throw in, and oh, by the way, he is the best doctor. By the way, she is world-renowned for her ability to take tonsils out, or whatever it is. And it struck me, because I'm used to hearing that, and we had some friends. I grew up in Big Rapids, Michigan, which is a small town, and there's an even smaller town to the north called Reed City, and they have a hospital there. And one of our friends needed some medical treatment, and they went to the Reed City Hospital and had one of the world's renowned specialists in this particular rare disease type thing that he had. And I just looked at my wife afterwards, after hearing this, and I said, honey, I don't think that the best guy in the world in this field is practicing medicine in Reed City. I could be totally wrong, but this is the reason I'm saying this to illustrate a point. A lot of times people will work with their financial professional or read an article like this, and then they go searching for something to back up what they believe. So they say, hey, I read this article, and this guy, he writes articles. He's amazing. It was in the financial press. He's got to be right. So they don't wonder, hey, does this apply to me? Is this article just clickbait? Are they trying to sell something? Yes, I had to put my email address in order to read the article. I mean, what should I be thinking about? And I'll even talk to, I mean, it reminds me of when we did the the Niles Open House, and I talked to a friendly guy from a credit union who said, well, yeah, we do what you guys do. And I said, oh, well, we do financial planning. And he's like, oh, yeah, we do that too. And they sell investments. Does not make them bad, but there's a huge difference.
Right, that is not financial planning.
So I would just be really careful when you read an article like that, because I personally love the sales. I love to be sold. I actually don't mind watching the infomercials, and I've wanted blue blockers. I've wanted to set it and forget it. I wanted the Ginsu knives. I have a Jack LaLanne juicer in my basement that was used 3 times. So I just
Floby. Let's get into some of the more interesting ones. I didn't know this about you, Kevin.
Yeah, I do. I don't.
ShamWow?
Yeah.
You are the only person I've ever. Your garage is the only one I've ever walked in and found a unicycle hanging in it. Oh, actually, not one, but two. Two unicycles.
Well, actually, there were 3. There was one for me and one for each of the boys.
Oh my.
So this is the thing. So you read this article, and you say, "That's it. That's all I need to know. I found the Holy Grail. It's a 20-year term. I'll get a 20-year term and be done."
That's my concern with so much information out there. Technology is taking over the financial services world, and it's just information. You've got to apply it to your situation, and the way to do that is through a comprehensive financial planning approach. We're gonna talk about it. But Josh, it sounds like you've got an idea percolating.
Well, I was just going to say, I mean, if literally there was one financial product out there that could solve everyone's problems, help them achieve every single goal, deal with every issue they could handle, then that one product would be the one that everybody has. But there's so much variety out there. They are not all created equal. Some are more expensive than others. Some do exactly what you need them to do, and others would be an inappropriate tool for you. And that's why financial planning needs to be the lens that you evaluate all financial products through. The product is just a tool to help you facilitate what you're trying to accomplish in your life, but the lens, the evaluation tool is financial planning.
Yeah.
And, I think I don't know exactly what article you were referring to, but someone gets to the edge of retirement, I think you had said, close to 65, someone then sells them a 20-year term life policy just because that's what they sell. That doesn't pass the sniff test for me.
No.
And that's a big deal. That's one of my quirks in life. I don't have a nose that works very well. When I start smelling something, I just go into like overactive sniff mode here because I want to know what in the world is that smell. This stinks to me, right? So you got to start asking some good questions, figure out what the issue is there. But the lens or the method of doing it is financial planning.
The folks who I've seen really say, nope, the all you need, 20-year term. Also, make another comment too, and we don't need to get into this because we don't need to arm wrestle on it, but whole life bad, 20-year terms, what you need. The truth is, there's lots of options out there with how you can protect this big risk, transfer this risk of you passing away prematurely, and how do you decide? How do you know of all these choices? How do you know what type of life insurance? We'll start there. What type of life insurance you need? How do you know? What are some of the factors? What are the things you need to consider?
Well, I think in order to know what type, you need to know what amount you need. That's the question that you have to answer first. If I'm on the verge of retirement, I need to know, am I self-insured? Because, and if I'm not self-insured, do I need to adjust something in my financial life in order to position myself to be self-insured? Because if there's any way that I could be self-insured, and I've got a finite amount of dollars, then I don't need to spend dollars on an insurance premium.
Yeah. So certainly knowing the amount. Go ahead, Josh.
I was just going to say, I mean, just summarizing what you just said, the first question is, do you even need the insurance?
Yeah.
And the closer you get to retirement, the more our hope is that the answer is no.
Yep. So how much do you need? The amount, what type, and then what's what's a fair price? How do you go about that? That's what's ahead here. We've got that and listener questions, a variety, some of them dealing with taxes, still in tax season. So got that and more coming up here on Wise Money with Korhorn Financial Group. Yeah, I listed those questions in the opposite order since we were talking about type with 20-year term. I started with type, but the very next question is amount.
No, I know,
but that's all right.
and I saw that, but I'm saying,
yeah, we can. Let's hit that first.
Because this is the problem. The
type's irrelevant if you don't need it.
Right. The question that got answered, if you come up with a great answer to what type, and you didn't answer the question, do I need insurance in the first place?
Yeah.
You've answered the wrong question. And
start with that. Let's start with that.
Start with why?
Because I think that's a big fear of people coming to a financial professional. Will they try to convince me I need something that I don't? Right?
Yes. But this, so to me, if I start with the premise I need a 20-year term, that was not process driven.
Right.
That was product driven.
Yep.
And I would want to make the distinction between process driven versus product driven, because if you go through a process and it says this is what you need, now you can go shopping, versus starting out with this is what I need because it's conventional wisdom, because it's a rule of thumb, because Rave Damsey says I need it, whatever it is you want to.
Yep.
I'm not try. I try to not say someone's name badly.
All right. Ready? We'll go with the flow here. Have you ever been concerned about talking to a financial professional because you might be concerned that they were going to convince you need something that you actually didn't? I think that's a big concern, and we're talking about the topic du jour right now is life insurance. I think that's a big concern. That will I go talk to a financial professional who's going to tell me I need something that I really don't need? So sell me something. And oh my goodness, that's where you've got to start. Do you need life insurance? Before you talk about the type, before you talk about the amount, because if the amount's zero, the type's irrelevant. So that's what we're talking about today. This is Wise Money with Korhorn Financial Group. Thank you very much for being with us. Also want to say thank you to the attorneys at Ladue, Kern, and Keene, as well as First State Bank for making the Wise Money Show possible. We've got a couple questions we're going to be hitting later in the program that deal with taxes. If you have any questions, tax-related, if it's personal, you need help, reach out to us as well. If it's a question for the show, just say, for the upcoming show or whatever. You can send us your question in a few different ways, reach out to us a few different ways. Online, wisemoneyradio.com. You can call or text us, 574-222-2000. That's 574-222-2000. And then everywhere on social media, not Instagram. I don't know how you take pictures of this stuff. Maybe someday we'll have an Instagram. But Facebook, Twitter, YouTube, just search Wise Money Radio. All right, so we're talking about the one-size-fits-all approach for life insurance that many financial individuals, I don't even know what to call them, because they're not financial planners. You wouldn't be doing financial planning if you said this one product is the right thing for everyone. It's not a financial planning approach, but there's this certain people who communicate when it comes to life insurance, all you need is 20-year term policy. Saw this in an article where someone was just about to retire, life insurance ran out, and so they kind of wrote into this financial individual, and his response was, you need 20-year term. What? What in the world? So I posed the question, how do you know what type? And Kevin said, no, you need to find out if you even need this, because you first need to know, are you self-insured? Do you need life insurance before you can address what type?
Well, do you need life insurance? Number one, so there's a process to determine that amount. But when you're looking at the area of protection planning, one of the things that you want to determine is, do I live with the risk or do I transfer it? You might even want to live with the risk. Live with the risk means I'm not writing a check to the insurance company. And why might you want to live with the risk? You might have, by age 65, most people have accumulated some type of health issue that makes life insurance more expensive. Life insurance becomes more expensive when the odds increase that you'll actually use it. So when you're young, if you were a healthy 30-year-old buying a 20-year term, they basically give that stuff away because no one's going to use it. Statistically, no one's going to use it. When you hit 65, guess what? In the next 20 years, it's likely that you're going to use it.
Did you catch that? That you just heard from Kevin when you need to make a great life insurance choice when you're young. And that's why sometimes people ask, "Hey, I'm just out of college or I'm newly married, I'm early in my career. Do I really need financial planning?" If you can set it and forget it, you said, Kevin.
Yes.
If you can make a wise life insurance choice when you're young and healthy and just have it be appropriate for your situation, wow, that could save you tons of money and heartache and pain.
Okay, the key phrase that you just said was appropriate for your situation.
Mm-hmm.
And that's why determining whether a 20-year term policy is appropriate for you, you have to consider what is the risk that you're facing. What does this life insurance need to accomplish? We often put this risk into two different categories. Do you have a temporary need for insurance or do you have a permanent need for insurance? Examples of temporary would be you're raising children, and if you and your spouse were to pass away, do you need to have a chunk of dollars set aside that will help raise these children if you're not here to earn a living that would accomplish that? Do you have a mortgage that is going to slowly decline as time goes on if you're here to keep chipping away at it, but if you were gone? Life insurance is a way to immediately wipe that out. When the mortgage is gone, that need is gone. So it's
Right.
hopefully a temporary need.
Both of those are temporary. That you're raising the kids for a certain period of time. Someday they're going to be, on their own and self-sufficient. So that's temporary. The mortgage, temporary. Saving up for your own retirement, so the income replacement idea, that's temporary. Someday you should be fully ready to walk away from your paycheck and not miss it.
So when
temporary need.
So when I look at that and I say, if I'm 65 and I'm buying a 20-year term, that's permanent. I mean, statistically, that is permanent. So I look at that and I say, hey, if I'm 65 and I go through an analysis and it determines that I need some insurance, and you say, well, why might someone need some insurance? Well, in retirement, if you and your spouse are drawing Social Security and one of you dies, their Social Security check goes away. So if your Social Security check is $2,000 a month and your spouse's is $2,000 a month, if one of you dies, one of those checks goes away. And if your expenses don't get cut in half at that death, then you might need something.
If you don't have other resources
If you
making
don't-
you self-insured, yeah.
But I would make the case, and so when you look at term insurance, the cost for term insurance is based on a few factors. One is, what is your age when you buy it? The second is, how much are you buying? So what's the volume of insurance? Am I buying $100,000 of term insurance or $1 million? And then the third is, how long am I buying it for? So you might look at a 20-year term at age 65 and say, that actually seems out of my price range. But you could look at a 10-year term. Most people don't know you can have a 15, a 10. Some companies sell 5-year term insurance policies. So you might say, hey, I'm gonna cut this, cut the baby in half here. I'm going to do a 10-year term, and by 10 years, we'll be 10 years into our retirement. If something happens after the first 10 years, we should be okay. So you take a calculated risk. Again, this is all risk management.
Risk management, absolutely. Absolutely.
Part of the issue with buying life insurance is it's a question of which years are you going to protect. Those early years when the need is so high happen to be the least expensive years to protect because the likelihood of you passing away in your 30s or 40s, even 50s, is pretty low. And but when you're buying protection for the years of your 70s and 80s, those couple of decades, the likelihood statistically, the insurance company knows these numbers well. And they know just how much risk you represent to them having to write a big check. And so they ask you to write a big check in the form of large premiums. And you have to ask yourself, does that fit in your retirement cash flow? Is it going to help enough to justify the strain that it puts on your cash flow in the meantime? Or, as Kevin said in the last segment, is this a risk that maybe you just need to live with? It really all boils down to what is the need that you're trying to protect. Because there are some folks who, even in their 70s or 80s, if they were to pass away, there would still be a financial hit to someone in their life, someone left behind. Maybe you have an adult child who is still a dependent and always will be because maybe they have a special need of some sort. That might be a scenario where you need the liquidity, the cash that's created by a life insurance policy to cover over the potential financial damage that that person would feel if you passed away too early.
And I don't know how you slice through all this stuff with a narrow perspective. If your perspective is starting with, as Kevin said earlier, well, 20-year term's the right policy, so let's just confirm that that fits you'll be confirmation bias there. If your perspective is broad, though, and you're looking at all 6 areas of your financial life, and you're proactive, and you're planning for the future, and you're thinking about the risks that are on your shoulders, that's a financial planning approach. That is the approach that you need when you're assessing, do you need life insurance? So what's the amount? Is the amount that you need 0? Or what's the amount? And then that will lead you to what type. Is it a temporary need? I don't know. I'll just say that from my experience, most people have a temporary need. I can't say all people have a temporary need because that's not true. It's not. So most people have a temporary need. You need to find out what your need is, whether it's temporary or permanent. And then lastly, we're going to hit in just a moment. Okay, well, what's the price? How do you figure out the price? And so we've got that and listener questions coming up here in just a moment here on Wise Money with Korhorn Financial Group. I want to hit that price stuff because I feel like we're in this all day, every day. So we just know, yeah, you A-rated companies and shop it. I think consumers, especially, I don't know if you've noticed, there's a lot more commercials out there about, can you run a mile in under 10 minutes? You qualify for life insurance. I think it's appropriate to talk about the shopping around that you need to have. Some financial professionals, they work with Minnesota Life Insurance, and so it's one size fits all. You got to talk about the shopping.
Yeah, and the other thing that I would want to say is that if you're making this decision in a vacuum, you're just deciding, should I get a little insurance for a long period of time for my dollar? Should I get a lot of insurance for a short period of time for the same dollars? And what's the trade-off there? Again, I got a great answer to the wrong question. The question is, if I've got risk management dollars, what type of insurance would be best for me and my family? Mm-hmm. Because if I'm going to spend $6,000 a year on life insurance, and the best type of insurance for me in my situation would be long-term care insurance, I missed the boat.
Yeah.
So,
however, in this vein, I don't know if you want to start with the idea of, well, like you do, at least for me, when I go shopping for furniture. I'm gonna spend $1,000, so that's my budget. What can I get for $1,000? Right? I don't think you want to take that approach with life insurance in particular. You first need to figure out what's your need,
right?
And then you need to have a great process to make sure you're getting it at a competitive price, and then you need to figure out because does that fit in your financial situation?
And if you're doing planning, and you say it doesn't fit, then you say, okay, what would need to change at the first death in order for it to work? And again, have very clear expectations. You're living with this risk. At the first death, this would have to change.
Yeah. All right. Hopefully we'll wrap this up and we'll get into that first question there. There's a question from Jerry about life insurance. I intentionally put a little a little buffer there so we'll see where we go. But third segment. How do you make decisions about life insurance? Do you start with, well, what's the cost? And that leads you down a path? We actually posed a different approach where you start with, what's the need? Do you need it? Are you self-insured? And that determines the type, that determines the amount. And then next, we're going to be talking about, well, how do you make sure you get it at a competitive cost? So, all right, this is Wise Money with Korhorn Financial Group. Thanks so much for being with us. My name's Mike, here with me as always in the KFG studios, Kevin Korhorn and Josh Gregory. Thank you to Bethel College Adult and Graduate Studies, as well as Diane Bennett and her team at Inspired Homes for partnering with us for the Wise Money Show. Thank you very much. If you have any questions, we've got a great question from Karen coming up here in just a moment. Reach out to us online, wisemoneyradio.com. Call or text 574-222-2000. That's 574-222-2000. And social media, Facebook, YouTube, Twitter. Just search Wise Money Radio. You can like the page. You can follow us. You can submit questions that way as well. So, okay, so we're talking about life insurance. Confusing. Lots of opinions out there, and there's an opinion that's pushing around that you should take a one-size-fits-all approach. 20-year term. That's it. And I totally agree. If you need a 20-year term policy, that's what you should have. But I totally disagree. We totally disagree. If you need a 10-year term policy, you shouldn't have a 20-year term policy. If you're one of the rare individuals who needs a universal life policy, no, you shouldn't have a 20-year term policy. So you got to start with a financial planning, comprehensive approach to diagnose that, to figure that out, and then that will lead you through the process. At some point, though, you got to figure out the price. There again, I'd want that connected with your overall financial situation, but I don't know about you guys, but if price is a component, how do you make sure you're getting life insurance at a competitive price?
Competitive price, but it may or may not be the lowest price. I was actually doing a little bit of price shopping or policy hunting for a client just this past week with a new employee. So I kind of had him shadowing me. We were doing it together. We were running some illustrations because we're an independent firm, so we're not tied to any one insurance company out there. We wanted to shop amongst the best and figure out which policy was appropriate for this particular client. So we ran our research. We came back with maybe about a dozen different policies, and he asked the question, well, why wouldn't we just go with that one at the top of the list, the cheapest price? And so I asked him the question, well, are all of these policies really equal? Are we really looking at an apples for apples comparison? And one of the features that particular policy didn't have, one of the bells and whistles was it didn't allow you to convert the policy into a permanent insurance policy. We were talking earlier about how many people have a temporary need. There's also permanent needs. There are two different policies, two different types of insurance to cover these needs, except what you don't realize is one can be turned into another. A term policy, what you believed was a temporary need for insurance, what if the fact pattern changes partway into that policy's existence?
If you haven't done the mental exercise of ever considering this, because this is totally geeky stuff, so high five to you if you have thought about this. Okay, well, what circumstances could move it from a temporary need to a permanent? And likely, would that mean a change to your health, where all of a sudden, if it was now a permanent need, you wouldn't be able to go out and get permanent insurance because all of a sudden your health just changed? Those are the circumstances.
Yeah, a change in diagnosis all of a sudden that has the potential to shorten someone's lifespan is the very thing that would make the need more obvious. That we need this life insurance because maybe I'm not going to go all the way to age 90. But it's also the exact same event that makes buying a new policy impossible. And so that's why some people convert a temporary policy, a term insurance policy, into something permanent, if they're allowed to. the policy, the rule book for that particular insurance contract is what determines whether or not you're even allowed to do this for the whole term period.
Right.
Not all policies are created equal, so you've got to look at the details.
And a little aside to that, watch if you have a term insurance policy, you can look in the schedule of premiums what happens if it's a 10-year term, what happens in year 11. They'll tell you what the cost is. And be careful, because if you are asleep at the switch and your policy is on auto pay, they'll keep taking the money.
Oh yeah, and you know what? There's I don't know if this is just sales kind of gimmicky, whatever. But if your policy says term to age 85, look at that schedule of premiums Kevin just talked about, because you might be guaranteed coverage until age 85, but the price could get wild on you, just wild. So, as Josh mentioned, we are independent. I'm going to just say, we're biased. I want to say that is the approach you need to take, because with term life insurance, you're locking that premium in. It should be a level term policy. So shop around. It's only good if the insurance company backing it is strong. Right. So,
but that's not the case to be made for you should overpay for your insurance.
Correct.
Because I have heard agents who work for a company. So this is the question. Is this agent working for that company?
Is your financial professional working for this company, or
because if they are, they likely don't have a choice of what kind of insurance you're going to get. They might even say, "Hey, I'm independent, and if you come to me, I can help you with life insurance, but you'll only get it from one company." That actually doesn't make you independent. That makes you a company representative. And so and another myth that people have that's out there is that, well, if I went and I met with Joshua Gregory and I needed a 20-year term, if I bought it from him, it would be more expensive than if I bought it online.
Right.
No, you know what? The price, if you bought a West Coast Life policy or a Lincoln National or a Prudential, go on down the line. There are many of them that we use and are able to access. The price, whether you buy it online or from us, is the same. It's likely that the experience is going to be different.
Experience, yeah, it could absolutely be different depending on the company, depending on the channels that you go through. One of the other things that can make what look like two 20-year term policies, they can have a different price tag attached to them, maybe because of how much scrutiny you have to go through in order to get that top rating with one company. There are some companies out there that, yep, if you got their best price, it is going to be better than everybody else. But there are just so few people who actually get that best price, you're more likely to get a lower underwriting rating. So look, you need to be working with someone who is familiar enough with the companies and can help you identify which company is most likely going to give you the best rate based on your health history.
Yeah, an example of that is if you are an occasional cigar smoker, some companies then label you as a smoker and you get smoker rates. Smoker, if you think about this, if I'm a nicotine user, I'm going to pay 3 to 4 times what a non-nicotine user would pay.
Yep, that's a fact.
So if I occasionally smoke a cigar, I'm going to pay 3 to 4 times if I'm working with a company that labels me as a smoker. Some companies will say that person who is an occasional cigar smoker is not really a smoker, so we're not going to give him smoker rates.
Yeah.
Yeah, good example.
So there again, it's I don't know. I'm glad you brought up the online shopping in this example, Kevin, because I don't know about you. I'm seeing more commercials about life insurance these days, and with the growing dependency of the internet, all of our life is on there, and so with certain financial instruments, yeah, you can find it cheaper on the internet. You can search around. Not with life insurance, and I think the risk. Such an enormous risk that you're trying to transfer, and the risk of making a mistake, the stakes are too high. Mm-hmm. So I'd want you to work with someone to make sure you get the right stuff with the right features at the right price, right? And so you got to have an independent, comprehensive financial planner.
Yep.
That's the recipe right there. Great question from Karen coming up about retirement and the turmoil in the stock market. What do we do? Oh, Karen's not the only one with this question. We've got the answer coming up here. Wise Money with Korhorn Financial Group. Right, that is okay. I lose track of where we are. This is for a segment.
Land in the plane.
I can see the caboose. Oh.
So
Stick with landing the plane. That's your stick.
That was good. I didn't really know how to craft the outline for this, and so we were bouncing around, but it was good content.
Well, again, all of this stuff, we spend all day, every day explaining stuff that doesn't make any sense. And the problem with buying term insurance online is you likely are buying it in a vacuum. You've either heard a radio show host tell you need a 20-year term policy, and so you just go online and buy a 20-year term policy, and that's great unless you need a 10-year or a 30-year.
Mm-hmm. Yep.
So it is.
Just a little touch bonus content for you on YouTube. The one that concerns me the most isn't that that an individual would blindly take that advice and actually be in the rare circumstance where they needed a permanent policy. That's not the one that concerns me. The one that concerns me is the 25-year-old or the 30-year-old that's like, yeah, I mean, I'm pretty young and healthy, and I'm working on my debt, and so I'm listening to this individual talk about all areas of finance, and yeah, I'll get a 20-year term policy. And they show up at 45 after a couple kids, older. I don't know if you guys realize that, but you get older, and all of a sudden they still have this need for insurance, and it's just going to cost more. Mm-hmm. I mean, think about, probably should have quantified what that cost difference could be to really wake people up with that, because you could be paying. I mean, if it costs you $1,000, and then later it costs you $3,000, that's an extra $2,000 a year for even, let's say, 10 years. Do the math. I'm not going to, because I'm just kidding. But that's a lot of money.
It's real money.
So,
Okay, so
all right.
So what do we?
We're for a segment. We'll just start with Karen's question and hopefully hit Karen and Jerry's question.
Are we going to start with Karen's question or Jerry's question?
Let's start with Karen's. Give it a little buffer. So, all right.
Dude.
Thank you so much for being with us today. This is Wise Money with Korhorn Financial Group, coming to you from the world headquarters of Korhorn Financial Group in Granger, Indiana, and the KFG studios. My name's Mike. Here with me, across from me, Kevin Korhorn. Between us, Josh Gregory. If you've missed anything, we've been talking about just a delicate area of your financial life. One of the biggest risks that you need to consider transferring, and one that you might be self-insured with. And that's life insurance. So if you've missed any of that, I'd encourage you, catch that content. You can do so on the YouTube channel. Just search Wise Money Radio, subscribe to it. It'll send you a little notification every time a new video is posted. So every episode's right there. You can find us on podcast, iTunes, Google Play, wherever you listen. Just search Wise Money with Korhorn Financial Group. I don't know how we do this, but when I type Wise Money, we don't come up. So you got to type in the whole thing. So maybe we can work on that. And then lastly, there's a media player on the website. Go to wisemoneyradio.com. If you're at work listening or just have your computer right there, you want to listen that way, every episode's right there as well. Also, you can submit questions that way. And lastly, I'll just remind you, we're about to hit a great question from Karen. If you have a question, you can also call or text us, 574-222-2000. That's 574-222-2000. Karen is 63 from Indianapolis. My husband and I are planning on retiring in the next 3 years, but with the recent turmoil in the stock market, we're not sure if it makes sense and if we're still on track. What's your advice?
I love the question and kind of the vulnerability. It's kind of a humble thing to admit, I'm not as confident as I once was. And a lot of people are feeling that way. When the stock market suddenly becomes volatile, especially on the heels of a year of tremendous growth without a lot of swinging, we can start to think, boy, if this investment portfolio of mine doesn't cooperate, is it going to put my retirement in jeopardy? That is a question that needs to be answered within the context of a financial plan. The very first thing I would tell you, Karen, is really just to seek out the advice of a certified financial planner who can help you analyze exactly where you stand today. And that is not a one-time event either. It needs to be something that you are revisiting on a regular basis because there is no perfect plan for you. Your circumstances are going to change. The world around you, the economy, your investments are going to throw you curveballs. And the more flexibility that you bring to your own planning, the more likely you are to make the appropriate adjustments. That is really where the value of a certified financial planner walking with you comes into play. They will help you make the adjustments to your trajectory, to your plan as circumstances change.
A friend of ours, financial advisor in Georgia, says you don't pay for the financial plan, you're paying me to change your financial plan.
I love that.
Because that really eloquently demonstrates that planning is a process because your life will change. So let me go back. I'll just go back 10 years and talk about 08, 09. And we don't know what's going to happen right now. No one does. Truly, no one does. Even if they sound like they do, they don't. But 10 years ago, we know how that story played out, and we'd have people come in, and some very, very upset. Everyone else, nervous, and several people said, "Well, I guess that retirement goal, that retirement idea is out the window," because we do planning. Actually, I was able to say, and we were able to say, no, hang on. We're going to talk about that today. That's the number one topic on the agenda. Let's revisit the plan. And for so many folks, you guys tell me if your experience was different, we just manage the trade-offs. And so, okay, well, if things don't bounce back quickly, well, in order to make retirement still work, you've got to work an extra year. Does that sound good? And I remember seeing the relief on people's face that, wow, not only is it still possible, I just need to make a simple adjustment. Oh, well, you need to save a little bit more. You said you wanted to live on $6,000 a month. Could you live on $5,000 a month? Yeah, I think I could do that. And it was just those types of tweaks.
Yeah, you're planning on going to Florida. Have you already made the deposit? Are you for sure going? Yes, I've made the deposit. I'm for sure going. Okay, where do we need to adjust elsewhere in your budget? Or if you haven't made the deposit, sweet. Is there any way you could handle 4 more months of gray days and hang out here? And so those are the trade-offs. And you say, okay, what do you need to do to be able to make it work? But this is where a lot of times when I come up against a problem and I find myself lacking creativity, I go to someone that can help me. And so this is where in your financial life, most people don't spend their days working with dozens and dozens of other people in their same situation. So it's quite possible you lack creativity to understand what's even possible. What are my options? What could I do?
So Karen, I received a very similar question from someone who I've been blessed to serve. We've been blessed to serve for, I think, since 2006. So we've been through a lot. She's planning on retiring, though, this year. And she sent me this email, your question, and said, hey, with the economy down, do I need to delay my retirement? I'm starting to announce it, but I can hold off. We'd positioned things. We've run the miles to figure out what the expenses were going to be and so on. So we knew what the income needed to be, and we had the income sources totally lined up, and they were not impacted by the market at all. And so in your case, and even for the other Karens out there listening, if with the market turmoil, if your investments are down a certain percent, it's not fun to sell them when they're down. But if you've set up your retirement in such a way where you've got fixed income sources and those income sources really are not impacted by what's going on with the market, I mean, your confidence maybe is shaken a little bit, but probably doesn't deter your plan.
Yes, and in the spirit of shameless self-promotion, I've been working with this client for 20 years at Notre Dame. And so as we've worked together, we've said, okay, what's the financial plan? When are you going to retire? What do you need to be doing? And so this client is a model client, done everything right, if you will. And then when they get an opportunity to be bought out, all of a sudden, when they're looking at planning on working 5 more years, and this possibility gets dropped in their lap, all you have to do, and again, we don't get paid to build the plan, we get paid to manage and adjust the plan. You put this adjustment into the plan and say, hey, will it work? Hey, guess what? The plan works even if you retired this year. Okay, well, if you're going to get bought out in June, what do you need to do to be able to retire in June? And one of the things for this client was get $25,000 into your 403B before you retire.
Yeah.
So we made the adjustment at the very beginning of the year to max that out, because this is a year where they're going to get half a year of pay and then a year's worth of severance in the same year. So I got a year and a half worth of pay, maximize that severance. So this is the case to say work with a planner, because when those opportunities come up, you either have the opportunity to do something about it or not.
I want to sneak Jerry's question in here. It deals with life insurance. He's 54 from Buchanan. I have a term life policy that's coming due later this year. Do I keep it after it matures, or get a new policy, or just let it drop? Josh, what do you think?
Most 54-year-olds that I know are not quite to the point where they can go without life insurance. You know, this will be my situation. I bought a 30-year term policy back when I was 24 years old. So I'm going to be Jerry here before too long. And I'm going to be facing the same situation. The 30-year policy is going to expire. Do I keep it and just pay those crazy high prices that it'll jump to? Or do I start looking at maybe replacing it with another short-term type of life insurance policy, maybe something that will get me all the way to retirement, when I hope I've done the hard work to get myself in a financial situation where that life insurance becomes less necessary and I'm willing to go without it altogether.
Yeah, so still take the planning approach, but inferring a little bit from what we can see here, Jerry, dangerous probably to just keep it and keep paying these astronomical prices. Might also be dangerous if you're not fully self-insured to just let it drop. You might be looking at a 10 or 15-year policy to get you past that temporary need. So great question. You too, Karen. All right, that is all the time we have for today. Thank you so much for listening. On behalf of Kevin Korhorn, Josh Gregory, and all of us at Korhorn Financial Group, hope you have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.